What's going on, guys? Welcome back to the channel. If you're new here, my name is Colton, and on this channel we talk about personal finance. If that's something that intrigues you, go ahead and like, comment, subscribe, share the video. All this stuff does help push out my content to other people who may find this information beneficial, and if you do so, thank you so much. As you can see in the thumbnail, what we're going to be talking about today is how to invest your money to become more prosperous in the future. But before we talk about it in a financial aspect or regard, let's talk about what investing is in general. So what does it mean to invest? To invest, whether it's finances or it's a particular trade, skill, hobby, it means to put in the time and effort so that you can have a better future in that particular field. So for me, as an athlete, and I prefer basketball, that's my favorite sport. As a basketball player, you can't just walk on the court and you can't just shoot and make every basket and know how to dribble, know how to even, let's just say, put on your shoe. These are all things that come with time. So if I wanted to make a layup or a free throw, I have to put in the work. I have to study, the angles, the force, the direction of the ball. And these are things that have become second nature. And the theory of it is the more time and effort I put in, then hopefully tomorrow, whether it's professional, recreational, I'll be a better player. But since this channel is about personal finance, let's talk about it in a financial aspect. So as you see in the thumbnail and in the title, we're going to be talking about investing in retirement accounts. So the two retirement accounts that I want to talk about are Roth IRAs and traditional IRAs. And we'll also mention about HSAs as well, although technically it's not a retirement account. So a Roth IRA is a tax advantage account that is more tailored towards people who are in a lower tax bracket. You are able to contribute $6,000 per year. That is fluctuating from year to year, but as of now, or as of 2020, the tax filing year, it is $6,000 per year. And every bit, every penny or dollar, thousands, whether it's tens, thousands, it is not tax deductible. So whatever you contribute, pretend that you are not going to be able to see it until you are able to retire. Or not even retire, but at that age that you are able to withdraw, it is 59 and a half. Though if you are starting late, let's just say 50, you have to at least have your account for 5 years before withdrawing it. So you can't just open one at 59 and say, I'm going to withdraw it in half a year and not expect to incur any penalties. So if you do withdraw before 59 and a half, you will incur a 10% tax penalty. So I highly advise, please do not do that if you want to have, if you want to invest with a clear conscience. If you are thinking about investing in a traditional IRA, this is something that is also $6,000 max cap per year. But every year that you contribute, no matter the amount, again, if it's $1, $10, $5, thousands, when you do your tax filing, you will get a portion of it back. But the bad thing about it is when you do withdraw your money at age 59 and a half or 70 and a half, which is when you have to take minimum distributions, you will have to pay Uncle Sam a portion of your taxes. So traditional IRAs are more tailored towards people who are now in a higher tax bracket, but they expect to live more frugally or with just less money when they are in retirement. But since most of us, at least people in my demographic may be in a lower salary range, then a Roth IRA is something that I would advise or something I would recommend. Now, to open up a Roth IRA or a traditional IRA, you can do this today if you wanted to by going on your website, going on the internet. I'm sure you guys know how to do that, and looking up Vanguard, Fidelity, or Charles Schwab. These are just three high-class brokerage firms that are able to, that you are able to set up within 5 to 10 minutes. And now you may be asking, okay, I open up a Roth IRA or a traditional IRA. What do I do now? Well, what you do is you go ahead and you allocate a percentage of your money into either stocks, bonds, or short-term treasury bonds, or you can hold it as a cash reserve. But holding it as cash is no different than holding it in your checking account or savings account. Short-term treasury notes aren't as growth focused. So let's focus on stocks and bonds. What is a stock? So if you look up a stock on the internet, whether it's by its ticker symbol or whether you just look it up through the database of Charles Schwab, Fidelity, or Vanguard, you will find hundreds and thousands of public traded companies that you can invest in if you wanted to. And the nice thing about living in the 21st century is that you can invest even a fraction of your money into a fraction of a share of these companies. And whether it's Apple, Microsoft, Netflix, anything that you could think about that's a big corporation, most likely you will find it on the stock market. Now for me, my approach is to look at it more passively. I go ahead and invest in ETFs, which stand for exchange traded funds, and this is basically just investing in a basket of stocks. So if I don't want to think about investing in one stock in case it does truly terrible, I don't want to rely on this one stock or one company to support my whole retirement account. So I invest in VTI, which is equivalent. You could find the equivalent of it on Charles Schwab or on Fidelity, but I invest in VTI, which is the Vanguard Total Stock Index. You could also look at something like the S&P 500, and there are certain ETFs for this as well. On Vanguard, there's also one called VOO, and this is just an easy way of just throwing your money into the whole US economy. Think of it like this: if you were a landlord and you had 500 properties, if one property failed and you only had that one property, you would be freaking out, right? You'd be thinking, oh my gosh, what am I gonna do next? Did I make the right decision? But if you had 500 different properties amongst the one community or amongst different demographics or different fields or different landscapes, and one of them failed, you'd be like, okay, I'm all right. I have 499 others. And this is the same exact mentality. If you want it to be a set and forget it with your money and just watch the money compound, think about investing in these index funds, whether it's Vanguard, Fidelity, Charles Schwab, and choose a passive approach. S&P 500, which has an average return of 12%, or total stock market index. These are the things that I recommend, and if you really want to just be a set and forget it. Otherwise, if you wanted to choose individual stocks, go ahead, you could do it with your retirement account, but I don't think that is the best decision. Now with bonds, they have a lower return, but a bond is essentially when you invest in the US government per se. It's backed by the US government. So certain projects, state, local, municipal, they have lower returns, but this is just a way for you to safeguard or to hedge your money, since stocks are more volatile. They fluctuate very easily, as you can see in 2018, 2008, and now with this illness going around. Back in late March up until about a couple months ago, the stock market plunged 20-30%, and that is the best time to buy in, because ever since then we've only seen upside. And so yeah, those are the two things that you can invest in, that I would highly recommend first investing in these retirement accounts. And the last thing, HSA, health savings account. This is something that's often overlooked, but nonetheless very important. Although it is not a retirement account, everybody or most people have health insurance, right? If you have health insurance, think about looking to a high deductible health plan, especially if you're in a younger demographic and you are healthier, because then you'll be eligible for these HSAs. In these HSAs, you can invest in stocks, bonds, just as I mentioned previously in the video with Roth IRAs and traditional IRAs, but it is triple tax advantage. What this means, you can contribute up to $3,500. It is tax deductible when you file your taxes. It grows tax free in whatever you choose to invest in. And when it's time to withdraw your money, or if you need it for a certain expense, use it only on particular dental and health purposes, and there are no taxes at all. So it is just a great way to safeguard your money, and I'm going to show you what I mean. So on HSAs, again, like I just mentioned, tax-free contributions. It is going to cost less than traditional plans, and when you use it for qualified health expenses, you won't pay any taxes. So what is a qualified health expense? So if you see here by all the purple check marks here, allergy medicine, vaccine, artificial limbs, body scans, chiropractors, and then there are some potentially qualified expenses highlighted here with the blue question mark. Don't use it for these non-qualified expenses like car seats, stuff like that. But you can see on this whole site, which I'll link in the description, everything that may be applicable that you can use your HSA money for and won't pay any taxes on. So you could think of it as, if you want to, a savings account. You can think of it as an investment account. I like to think of it as a multitude of both. And last thing I wanted just to touch upon is, why should you invest now versus investing, 10, 15 years from now? Say, hey, Colton, I'm not ready. I barely make any money, or I just want to have fun. If you spend $5 on your Starbucks every day, you can contribute $5 to an ETF within one of these retirement accounts. And trust me, if you just think of it as depositing in a savings account, set and forget it, you will have exponential growth in the future, as shown by this little display. So we have two people here. We have Jane and we have Chris. Jane contributes $6,000 per year, which is the max contribution, at age 25 for 10 years. And at age 35, she's just like, I'm done. I'm not going to contribute anymore. But look at the power of time and the compounding of your money. From age 35 to 65, after contributing for only 10 years, she has an average return of, she has an average balance of $675,219. Whereas this gentleman, Chris, he waits 10 years and he contributes $6,000 per year for 30 years, 3 times the amount, or 3 times the time that Jane does, and he ends up with less money. This is, of course, assuming a 7% return, which is less than the average if you invested 100% in stocks. But it just comes to show that time is very important. Time is on your side, and whatever you can contribute now, you will see exponential growth. Maybe not in the first couple years, since there is a cap on how much you contribute. But 10, 20, 30 years from now, I promise you that the money grown from compounding is going to be more than the amount that you contributed. And this is why you should invest in your future. If you love money, whether you feel like, hey, I may not be financially secure, I may not have a better paying job, investing is right for everybody. And I hope that this video shed a little light on that. And with that said, this is all that I have for the video today. I really hope you like the content. If you do, again, just like, comment, subscribe. These little things really do help out the channel. I'd love to hear if you have any suggestions. I'm just starting out, but I do really have a drive to share this information. And if anybody has something to say, feel free to drop it. And with that said, guys, I'll go ahead and see you in the next video. I hope you all stay well and take care, y'all.